Happy Monday out there, Team 42. It's your skipper here, Darius to present our macro minute for Monday, November 11th, 2024. Also wanted to say happy Veterans Day out there to our military men and women and the military families on Team 42. We just want to say we thank you. We appreciate all the sacrifices that you guys make to allow fat people like myself to sit in chairs and type and crunch numbers in Excel. So appreciate all the sacrifices you guys made for our country. So we'll start with the executive summary from today's leadoff morning note. As always, if you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, what will disrupt the year-end performance chase? Our answers are, with the U.S. election risk out of the way, investors must turn their attention to a far less exciting set of macro catalysts. Each week that goes by without a significant negative revision to the consensus growth, inflation, or policy outlooks will afford global liquidity the scope needed to catch up to where its leading indicators suggest it ought to be. Bitcoin, 100,000 by year-end is not unreasonable. We view China's activity in property market data at the end of the week as having the most potential to cause volatility, given that China is a core feature of the currently positive and likely accelerating global liquidity impulse. Additionally, Fed Governor Chris Waller on Tuesday may hint at Fed balance sheet policy. Ending fake QT is an option if the Fed loses economic support to continue cutting the policy rate in the coming months. Transitioning to our 42 macro dashboard here. As always, we'll wrap up with the question from our community. This one's regarding how to play year end. This says, hi Skipper, with $2 trillion moving into U.S. markets in the last 5 sessions, will fund managers take year-end profits or hold in fear of loss? I'm not sure I understand that second part of the question, but I guess the general gist of the question is, do we want to be playing the the desire of fund managers to take profits or the desire of them to sort of chase performance? In our view, we think that the probability that a performance chase continues is much higher than a probability of a significant profit-taking exercises that cause, let's say, the S&P 500 to be down by year-end from where it is from today's price, or Bitcoin to be down by year-end from today's price. What we've observed historically, you can see this empirically, generally speaking, whenever you have a raging bull market that persists into November, December are typically quite positive, with November typically being the most positive month. But you tend to see Santa Claus rallies extend themselves into December. And again, we don't play, seasonality as a investment strategy here at 42 Macro. All of our investment recommendations for our clients are made through our systematic KISS portfolio construction process, which is a trend following strategy on 60% stocks, 30% gold, 10% Bitcoin. And then we use our trend following elements of our process to dial up and dial down exposure to either maximize upside capture in bull market and minimize downside capture in bear markets. And then we use those same trend following process in our discretionary risk management overlay, which is a more sophisticated system that we maintain for our institutional and sophisticated retail trader clients. And that helps them, sort of stay on the right side of factor risk, within the various factors that comprise the equity, credit, cryptocurrency, and commodities markets. So either way, both of those strategies are systematic strategies. And so as long as those systematic strategies continue to support positive upside momentum into and through year end, that's what we were going to be recommending for our clients to do. It's not going to be based on my view of seasonality or my view of what fund managers are doing or my view of what growth is doing or my view of what liquidity is doing, my view of what inflation is doing or policy is doing or corporate profits are doing. All those things are important elements to discuss and unpack because ultimately they give our clients, the sort of emotional confidence to make the appropriate pivots in their portfolio when our systematic trend following elements, change course and change the direction of the risk that we want our clients to be taking and asset markets to remain on the right side of market risk. So wrap it up there. Darius presenting our macro minute for Monday, November 11th, 2024. Everyone have a wonderful day out there. Best of luck. We'll catch you back here tomorrow. Cheers.